What's up, guys? In today's video, I'm throwing you right into the middle of our most recent webinar. I want to get this content into your hands, so if you enjoy this 8-minute clip and you want to see the full presentation, just click the link in the description. You can put your name and your email in for free. I'm going to send you the entire hour-and-a-half presentation that we went through here just a few days ago. So enjoy, take some notes, and if you have any questions, comment below, email me, or of course, just DM me on Instagram or Twitter. Make sure it's the real me, not a fake scam account of me, but just reach out to me. I'm more than happy to help. So enjoy the webinar. And again, if you want to see the full thing, link is in the description. I appreciate you always. Take some notes and enjoy. Now you're going to say, well, Austin, why do these patterns exist? How do we know that we can trust indicators? Let me show you. So this is the Bank for International Settlements. I put the source link here if you want to go look this up, or email me, I can send it to you. But this is a report that they put out, a white paper that they put out in 2020, end of the year. And basically what it says, if you were to read this whole paragraph, one central bank indicated that it used expert advisors or algorithms for 90% of its overall trading volume. Two used expert advisors or these algorithms for 25 to 30% of their overall volume. Here at the bottom, it says more than half of them use time-sliced algorithms for more than 70% of their transaction volume. So what does that mean, Austin? What is an expert advisor? What is an algorithm? Why do I care? Well, because these algorithms are being used by central banks. This survey by the BIS is done around the entire world of all the central banks. And this is telling us that algorithms are driving majority of the trading that they're doing, especially for these major central banks. So if we know algorithms are driving price action, we can actually defeat the idea that trading indicators don't work. Because even if it's just 1 percentage point more than the majority of trading, maybe 51 versus 49%, then that algorithm, in my mind, would then drive overall price action. So the idea that technical indicators don't work is actually missing the back half of the sentence, which is that they don't work in every market. So what do I mean? This is a stock, CGC. If you were to look at this, this is from December. You have the 6th, the 7th. You can see the dates at the bottom. Look at these gaps day to day on these vertical lines. Those dotted lines are the period separators. They separate the day. So these gaps every day, when price ends here and it ends up opening here the next day, that makes it really hard for technical indicators to paint clean, reliable levels and clean information that we can trust. So over time, just follow me on this theory here, so to speak, because most people trade stocks, this stigma was adopted that technical indicators don't work. But we now understand why technical indicators don't work. It's because they're gathering data from price and price gaps in other markets, particularly the stock market, where that stigma comes from. And we now know that Forex doesn't gap as often, not at all, which would then tell us that we could possibly rely on these technical indicators more so than were we to use them in a different market with gaps. I hope that that makes sense. The gaps make it hard for the indicators to gather reliable data. This is why most people say indicators don't work. But when you put it in the Forex market, it translates to clean price action with few gaps. Now, a lot of you guys know I use black candles, but I want to show you briefly why I do that. You see how big green candles, like you see here, these 2 green candles, and even this extension here on this last one, that can create FOMO. It can make you feel like you're missing a move. But if we were to just make them black candles like this, there's just much less emotion attached to the colors. If you want to argue with me about colors creating emotion versus not, we'll have a psychology webinar to discuss that, but that's not the focus for today. It's what's worked for me, and that's why you're going to see black candlesticks today. And another reason that black candlesticks work, for those of you that are a little bit more advanced, in the Forex market, because we don't have gaps between candles as often, these candles are painting right next to each other. So I don't need to know what color it is to tell me if it's a bullish or a bearish candle. And in the beginner course, I teach you how to have that same understanding. But at this point, the color of the candle is irrelevant to me. And it removes emotion, which is why I trust it. So now let's talk about the technical indicators that I use, that I've tested for our systems. The first one is the 8 EMA. It's this yellow line that you're going to see across my screen. The second one is a 21 EMA. And for simple terms, simple understanding, when the 8 EMA is above the 21 EMA, we are in an uptrend. On any time frame, on any asset, any investment, when the 8 is above the 21, it's a short-term uptrend. We also have the blue line here. This is the 50 EMA. Now, when price is above the 50, again, you could think it's more in an uptrend than in a downtrend. Even though there'll be short-term pullbacks in that overall uptrend, if price is above that 50, we're in an uptrend. Same thing if it's below the 50, we're in a downtrend. Now here we added in the white line, which is the 200 EMA, and the blue line, which is the 800 EMA. So again, the 5 that I use, the 8, the 21, the 50, the 200, and the 800. Now, quickly, the reason why I use all 5 is just because they're pulling from different periods of time, giving me an indication of trend over longer and shorter periods of time. So when we talk about weighing probabilities, if I can get all of my time frames, all of my EMAs to pull data and tell me that we're in the same trend, that's going to be a more probable setup than if the EMAs are all crossing each other across the screen, telling me that over time, this doesn't know if it's been in an uptrend or in a downtrend. So right there, we can see how these technical indicators are giving us an idea on the direction that we need to trade. Now, to take that direction a step further and find out how exactly we should be getting into these trades when the timing, right? Direction and timing is what we need. That's where we use the TDI. This is the Trader's Dynamic Index. If you look, this has three components. A real TDI, a real one, like the original one, has Bollinger Bands on it. You won't find that with me. We took those off. It was adding too much extra stuff into our checklist. So here, the green line that you'll see is a relative strength index. The red line that you're going to see on the bottom here is called the trend line, and the yellow line is called the liquid 50. The beautiful thing about this indicator is that it pulls data from volume. The RSI is reading volume to pull data. The two moving averages, the red and the yellow line on the TDI, the trend line and the liquid 50, they are pulling their data only from the RSI. Now, the EMAs are pulling their data from price action. That's what goes into computing the formula that paints an EMA. All that line is it's adding up some numbers with previous price action and continuing to paint a line. So price action is painting the EMAs. The TDI is using volume. If we can confirm what price action is saying with volume in the same trend, in the same direction, with the same bias, then we're putting probabilities in our favor. So I'm hoping that I just kind of crushed the idea that indicators don't work. EMAs are going to give us trend. TDI will confirm or deny that trend. And once we have a confirmation of trend, then we're just waiting to find the right timing to take our entry. So now we're taking indicators that people would say don't work, and I'm proving to you how you can prove to yourself that they work. So knowing what we now understand this far into the presentation, we can build rules around what the indicators and price action are telling us in the Forex market. I'm not saying this is going to work if you go try to do this in stocks. I don't think it will. The gaps make a difference. Think about it. It's trying to use previous price action to add up and paint a clean indicator, but then it gaps 100 points. That's going to make the indicator show a crazy reaction. That's why people think they don't work. So now what we can do, though, with this understanding that we need rules behind indicators to build characteristics into our chart, we can get to work proving if the system works. So let's talk about testing a strategy for a second. When we use these indicators, as I just said, they give us data that we can use to create questions that will then go into our system. The questions should be based around the idea of what could be better. What is a full trend versus not in trend? Where are probabilities in my favor versus where are they not in my favor? And these questions will create parameters that we can then, like I said, turn into questions and ask ourselves, could this be better? If it could, then maybe this is a setup we want to be waiting for. So now we're really systemizing our process. When we really go through these questions, you're going to see we're systemizing the process that we apply when we go to trade. But before we go to put live money in anything, we need to do backtesting. So here you can see this is just 2020. August, all of these are individual files. They're individual photos of ASFX entries. Winners and losers. You have to be unbiased, but there's August, here's September, here's October. So when you talk about doing the work, this is where I flex and I show you I do the work. Every day I'm doing multiple markups, forward testing the system. There's December. You get the point. So what these markups are, what those files look like is this. They're chart markups that show our system. They have some details here where we can say, okay, this was a setup at 6:30 in the morning, New York time. I was awake looking at this. We're looking at 17 pips of risk with the potential for 36 or more of profit. The TDI could be better, but this looks like it could be a good risk reward setup for the ASFX systems. And what ends up happening? This one ends up being a massive mover, over 113 pips. So you risk 17, you make 100 potentially, you're looking at 6 or 7 R on this. R meaning R multiple.